on first-time home buyers.
I actually want to get asking about fixed rates,
Yeah, sure.
variable rates, how the government bond yields affect mortgage rates. So, can you explain a fixed rate?
Sure. You want me to explain like the difference between the two first?
Yeah, so maybe
Yeah,
between
like
fixed
because
and
like right
variable.
now we're seeing more people jump on and kind of get into a fixed rate rather than like last year. I'm guessing you probably saw more people leaning towards a variable rate,
Yeah.
correct?
It's funny, man. I think, just from my experience with clients, they lean into their professional. What I mean by that is they trust them.
Yeah.
So if I'm telling them I think you should go this way or I think you should go that way, they might listen. But I don't talk like that. I give them the pros and cons, the risks and the benefits of both options. And based on their financial situation, based on the tolerance for their own risk, they can decide which way to go. But the basic difference is a fixed rate mortgage, the interest rate and the payment is locked in for your term length. A term length can be a 1-year term. You can go all the way to 10 years. Most common is a 5-year fixed or 5-year term.
And sorry, in that fixed rate, between say 3-year, is there a difference between 3-year and 5-year what the interest rate is?
Yeah, there is. So banks make the most money the longer you're locked in for 2 reasons. In a high interest rate environment like we're in right now, if they get you to lock in a 5-year fix at 4.99, and if they anticipate rates coming down, they know they just locked you in for 5% when you could have got a 2-year and then renewed into a 2%.
Yeah.
That's one way they make money. The second way, which is arguably their most profitable and sneaky way, is the break penalty. If you get a 5-year fixed and 2 or 3 years down the line, you sell or you refinance and you can't port that mortgage over to your new house, they can charge you with a huge penalty. Especially like I've seen penalties, $30,000.
How much left? How much left on the mortgage at $30,000?
Like $500,000, which is like, what is that? 6% of their mortgage in a fee.
Yeah.
That's why banks. All respect to my lending partners, I love my banks, but a lot of them push the 5-year. I don't want to say I don't blame them because they get more commission for that, right?
Yeah.
The longer they lock in. Same with us, but I don't push one way or the other. Like if a client wants to go fixed, I will advise them, listen, rates are high right now. If you think rates are going to come down within the next 5 years, then there's no point in getting a 5-year fixed. You should get a 1, 2, or 3 year.
Yeah.
After that's done, see where the market is at, call me, and we can see where we can renew you at.
Okay.
So that's
That's
fixed.
fixed, right? So
and then there's variable. Variable, I like variable. Variable is for someone who is able to sleep at night, even though things are not guaranteed and certain.
Like to gamble.
A little bit, maybe an investor type, maybe someone who's willing to take a risk, someone who understands the market more and understands how it works. Because if you look at a past 30-year chart of fixed versus variable, on average, variable is less. When you get a fixed, you're paying a little bit of a premium for that security of it never switching.
Yeah.
Whereas variable, if the rate goes up, your payment also goes up. If the rate goes down, your payment also goes down. So that's variable. There's actually 2 types of variables without getting...
Yeah, so I want to ask you, I know there's 2 types.
Yeah.
So if you wouldn't mind just
of course.
touching on the 2 types and what their names are.
I got you.
Yeah.
Variable is a generalized term. Technically speaking, it's a static variable mortgage and an adjustable rate mortgage. A static variable, a lot of clients picked it and then regretted it. They advertise it as when the rate goes up, your payment stays the same. The amount that you pay towards your principal goes down and the amount that you pay towards your interest goes up, right? But that only happens until what we call a trigger rate.
Yeah, so
Yeah.
because we're seeing a lot of trigger rates. Yeah, explain what trigger rates are
So
as well. Yeah.
that strategy of static variable only works if the fluctuation in the rate is super small. When rates have gone up 4% like we've seen, eventually the amount of interest that you owe is no longer being covered by your monthly payments. And when that happens, you reach your trigger rate and the bank says, listen, Mr. Smith, your $2,000 payment, we appreciate it, but your interest is $3,000 a month. So you need to increase your payment now. And now all these static variable holders are shocked because they just went from a $2,000 payment to a $3,000 payment overnight. Whereas an adjustable rate, every time the Bank of Canada increased it, 1/4 point, 1/2 point, 1%, they felt a small increase in their monthly payment. So they weren't completely shocked. They felt the same $1,000 increase, but it was level.
It was a little bit at a time, right?
Yeah. That's why if you do go Variable, I'm more of a fan of a true adjustable rate mortgage where you pay as it goes up, you pay as it goes